Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. I hope you're all doing very well. Today, I hope you like my new setup. I'm using the new webcam. The library is slowly being built out amongst many other projects, and the new, of course, Rode mic. Sound kit essentially. So ready for some higher level production quality following the advice of my good friend Fabio in the comments section, who suggested I go long a new mic. So I've done that. Before we get into today's stock analysis, I would like to know, who would you like to see and hear on the channel in conversation with myself, and what sort of questions would you like me to ask them? What I'd like to get your input on moving forwards is what kind of things would be valuable to you, because essentially this started off as my own creation, kind of like a video diary for my own personal amusement. And it seems that people are finding some value out of that. And now I want to dig into that a little bit more and see what type of value I might be able to provide for you guys. So that being said, let's get into the meat of today's presentation. The reason that you're here, no doubt, is to look at my thoughts and give an analysis on a particular company. And today we are going to look at Callan Petroleum Group. If you haven't already liked and subscribed to the channel, I'd greatly appreciate you doing so. For those of you new to the channel, I'm a popular investor on eToro. It takes up a disproportionately large amount of my time, considering it's a very small percentage of my investment focus. However, it's extremely enjoyable and extremely interesting and rewarding. So let's get into it today. Callan Petroleum Group. Got a new format. I hope you guys like the new format. I'm going to give you a one-page macro overview in the given sector of a particular company or asset that I might be interested in. At the moment, I am focusing obviously on stocks or assets held in the portfolio, because that is publicly available. The ones that I own outside, I do comment on, but I just tend to weight most of my time towards the eToro portfolio, because it is something that other people, you guys can look and see. It's publicly accessible. So one page macro as of end of August 2022, commodities, particularly oil, are at the start of a secular bull market. That's a part of a thesis that I have, and a thesis. OPEC Plus are on the brink of reaching their spare capacity. This has been first pointed this out. It was kind of seen as a contrarian view. And at the moment, more people are starting to come around to that point. And I know that Lee Goering and Adam Rosenzweig of Go Rosen have put forth this well in advance, and their idea that OPEC may reach spare capacity by the end of this year, being 2022, looks to be ever more prescient as we move on into the tail end of this year. SPR releases are scheduled to end at the end of October of this year, before the midterm elections in the United States. That will essentially, I think that's been holding back the price of the oil at spot and in futures reaching record highs. And so it will be very interesting indeed to see what will be the catalyst for holding down oil prices when that SPR release either ceases or slows dramatically in the end of October. China in lockdown, China being released out of lockdown potentially will add to the demand side. So you may have this drying up of supply and this unleashing of demand right at the same time. Interesting new work since I put this slide together at the potential of a deal with Iran. That seems extremely questionable at the moment. In any case, another great point put out by Josh Young of Bison Interests would be that in the event that the US or the Western world did come to terms with Iran, OPEC may then choose to reduce their production in order to offset that new supply. So very, very interesting geopolitical plays at foot. E&P, so explorers and producers, as a proxy or levered bet on the commodity itself. Obviously, they produce the oil. So if you take a particular view over that commodity, the explorer and producers are a way of expressing that. E&Ps represent a generational opportunity. I'm not the first to say that. When you look at commodities or E&P versus crude futures, if you look at energy versus a historic valuation of the S&P, it makes up a very, very small percentage still in terms of its historic weighting in the S&P. And energy is what drives the economy. So you can't have an economy and a broad index in the stock market taking off without energy, essentially. And so I think that the tides are starting to shift in that regards. We have a highly unstable geopolitical environment, to which I alluded to beforehand. And so, anything can happen to disrupt the supply. A coup in Iraq during the week, a potential deal with Iran. It is really just rumor at the moment. And so anything can happen with regards to potential disruptions in supply as a result of geopolitical tensions. Canadian and US E&Ps are probably the highest percentage plays. If you have a stronger stomach, there are some fantastic risk reward or high risk, high reward plays, for example, in African exploration and production, in places like Petrotel in Peru, in Colombia, and of course we do own some Petrobras. Okay, so the largest petroleum producer in Brazil. So if you're willing to go further out on the risk curve, there are some high reward but also high risk opportunities. Canadian and US is the main way in which I've chosen to express and take a position on this thesis. This is what I was alluding to when you look at energy or commodities, in this case, broadly speaking, as a percentage of stocks, equities. This chart from Incrementum AG has been rearranged by Tavi Costa at Crescent Capital. And so you can see we are trading at historic lows in terms of valuations of commodities over the equities in terms of a ratio. And it's certainly not unreasonable to think that if you look at the Gulf War, if you look at the oil embargo, we're getting possibly close to a Russian oil embargo. So it's not out of the realms of possibility where we will see this start to revert to the mean somewhere along the midline, which if you look at the purely on the numbers perspective, that may indicate a fourfold reversion towards commodity prices in general. And of course, we tend in commodity cycles, we tend not to see purely a reversion to mean. It tends to overshoot on the upside and the downside. Obviously, here with this overshooting to the downside in terms of historical valuation, I don't think it's particularly unreasonable to expect that to overshoot to the upside. S&P with energy as a weighting of that index. So this is saying if you look at the index and you value it as a whole, how much of that valuation does energy represent? And it's at extremely low levels, okay? Almost generational low levels here. If you look over the last, 3 decades, let's say, it's just such a tiny percentage for the sector that makes the economy, essentially. So I would expect us to get easily around to 10%, but once again, it tends not to revert merely to the mean, but it tends to overshoot. So we might be looking at a doubling in terms of the energy sector as a whole. Money flows moving into the energy sector as a percentage of the S&P. We may get a tripling. It'll be very, very interesting to see. Now, that's the whole energy sector. It's not necessarily oil, but oil, I think, is the most pressing, the lowest hanging fruit in terms of being able to bridge the energy gap that we're experiencing in many places around the world. Okay, a chart. These sorts of charts to which I refer all the time come from the 9 Points Energy Fund run by Eric Nuttall in Canada. This chart is measuring the free cash flow yield versus enterprise value and the market cap, okay, to the equity price. What's the difference? The difference is when you're measuring it to the equity, it's just a pure share price. So how much free cash flow is the company expected to produce versus its share price? The enterprise value takes into account the company's debt load, okay? So I tend to use the enterprise value to cash flow. Assumptions here are $90 oil prices into the next year, and the forward strip, so using the future strip for gas prices. If I draw your attention up here, I've highlighted where Callan Petroleum sits. Essentially, according to the valuations, Callon is trading somewhere near 37-ish% of its equity in terms of free cash flow, which is obviously tremendous. And then if you look at the EV to cash flow, you're paying less than 2 times enterprise value to cash flow. I mean, just unheard of valuations for all of these. In this particular quadrant in the upper left-hand side, I'll take a brief moment to touch on some other names which are of interest. Ovintiv, we do own in the eToro portfolio. Okay, so I do own that. CPG, Canadian company that I own outside of that in another portfolio that I'm in charge of. Enerplus is one that I have a very heavy weighting in. PDCE, we also own in the eToro portfolio. Baytex, I do have a light position in outside of the portfolio. Synovus, slightly off to the right-hand side here, we own as well as one of our main positions. Synovus is a large cap. Being able to have one of the finest large caps in the world with refining capacity as well as production capacity is, and to be able to buy it at less than 3.5 times the enterprise value is obviously obscene. And Meg Energy, one of my absolute favorites in the heavy oils, trading at generational lows with potentially, if you look at the proven and probable reserves of around 37 years, you're buying it for maybe 2 to 3 years worth of production and getting the rest for free. So very, very interesting stuff. I will move on now. Basically, the whole sector is good value if you were to take that at face value. Now, I'm going to give you a one-pager on the company. Okay, so this is obviously Callon. Revenue is expected to come in just shy of 2.8 billion US dollars. CAGRs over the next 5 years expected at 11%. I think it might even be a little bit better than that. EBITDA 1.8, same kind of CAGR analyst expectation. Free cash flow, I've got an asterisk here. It really does depend on the strip. Management has given guidance. They gave initial guidance at the start of the year of around 750. That's been revised down to 500. So you've seen the share price sell off. The reason being they had some scheduled and unscheduled disruptions to production with electrical faults and different things. So we will need to do a range of free cash flows for our valuation. I'll show you how I've done that in a moment. Now, this is very important. The enterprise value is quite high because it does have a decent amount of debt load still. So we need to be mindful and cognizant of that. But the question is, what's the serviceability like and what are management going to do about it? So if you look at enterprise value to free cash flow, I think that, you know, in a $75 oil environment, that's where they're getting their 500 million free cash flow. I think it's very conservative. And I think that 10 to 15% EV to free cash flow yield is very, very good. Historic mean multiple, so their market cap to free cash flow is 11 times. So normally, historically, people have been willing to pay up to 11 times the free cash flow. And at the moment, you're looking at less than 3 if you look at it to the equity price. The reason it comes down to a 10 to 15% yield is if you add on the debt, which we want to do. Net debt at the moment, 3 billion. So it is a decent amount of debt. 62 million shares on issue. Price, as at the time of this slide, was $40.99. Very interesting. The book value of the company's analyst estimates are about $36. And I think it's by the end of this year, 2022, they're expecting it to be around $45. So potentially buying it for less than book value. The return on equity is outstanding over the last 12 months. However, that doesn't take into account the debt. So sometimes that can be tricky. The return on the equity doesn't reflect the debt necessarily. It can be made to look artificially higher if the company is highly levered. So if you look at return on capital, 22%, which is still very, very good. Nothing in the way of buybacks really, because they're prioritizing paying down the debt. And then management have stated once they hit their certain debt targets in tiers, what is happening across the sector is huge amounts of that free cash flow going to be given back to the shareholders as opposed to being reinvested in future production. Qualitative analysis, it's a way to gain exposure to the US side of the border. So we're heavily invested in Canada, and we have quite a decent holding in Brazil. Quality management, CEO John Haddock is an experienced investment banker, so he's very well versed in M&A. and they have been engaging in a consolidating play or a roll up in acreage in the Permian Basin, which is, I would estimate, is probably the highest grade and most sought after acreage in the world when it comes to energy, or particularly fossil fuel production. They've made some very good acquisitions, and the true value is not reflected on the balance sheet. So I think that is I think that's a really important point with this company, is that as good as the balance sheet looks, and that we're getting it for at book value or maybe a slight discount to book value, let alone the cash flow, I think that their acquisitions will really pay off into the future. In this point of in this point of time where hydrocarbon energy production is really out of fashion amongst the political elites, these guys have been able to buy up cheap acreage, and I think that's going to be extremely valuable moving into the future. So some notes on their M&A: accretive acreage and production through certain deals. I'll outline two of them. The Carrizo oil in 2019, obviously it wasn't a great time to be making moves just before COVID, but these things happen. The good thing was it was an all-stock deal that dilutes certain shareholders, I guess, but they were able to acquire these shares when they were 80% down, or that they declined 80% in price. So Callon was able to use their shares to acquire the business, and whilst that business, the Carrizo shares, which they were acquiring, were extremely depressed in terms of their valuation. So over time, I think that's going to be extremely accretive to the value of Callon shares. Premax in 2020 was another good one. Management are guiding $500 million in free cash flow. As I said, that's using a $75 average WTI price. Obviously, we're a lot higher environment, so barring any future disruptions, we should be able to clear that hurdle fairly easily in terms of 500 million. That will allow them to rapidly repay their debt. I think they're going to repay their debt faster than the market expects them to, and that will lead to a much higher valuation on their expected cash flows into the future. They have a large amount of torque to the higher oil prices precisely because of that leverage. And as I mentioned, I expect them to pay down that debt quicker than the market is thinking. I'm going to move that down and let's take a look. So here is a rough model using a DCF out over the next 4 to 5 years. The assumptions you can see here, and what you'll see is I've given them, I would say a medium to conservative valuation. I've given them a 4 times multiple, which is extremely, extremely low. So I'm really and truly valuing them on their cash flows. And I'm saying that they're only ever going to, they're going to have a 25% free cash flow yield, essentially, which I think that when we get into an environment where people are looking for high returns on their investment, I think that you're probably more likely to see a 6 to 8 times multiple for a business that can operate in the finest acreage in the world, essentially, for energy E&P. Be that as it may, you can add your own assumptions to this, obviously, and you can see the ones that I have in the columns, so totally transparent. If you were to take this particular valuation on its merits, you can see that at an entry price of roughly $42, I'm getting an intrinsic value somewhere close to $69 over the next 4 to 5 years. I think that's extremely understated. And I think that using that conservative valuation, we get an IRR of 21% on our average entry. So our current average entry in the position in the Toro portfolio, we paid $46.80. On a book value of conservatively $37, probably more likely to be $45 by the end of the year. So whether you look at it from a balance sheet perspective and you're saying we're buying it for roughly 1 times book value, which is very, very cheap, or we're looking at the cash flows and saying, look, this is a very conservative estimate as to the type of cash this company can produce. You'll also note here, I've given them no credit for their taxes. And I think that instead of if you look at the column here, 350, they should have enough credits to pay no tax, okay, because they've banked up their losses from previous years. And so you would add that on to available discretionary free cash. The wild card is I can easily see an environment in the future where we start to see increased royalties and taxes from the producers. So I've just left it in there as a way of being conservative with the future cash flows. But obviously, you could see that would significantly increase the intrinsic value. Okay, so let's take that and move it into different probabilities, because again, if you're basing something on the commodities, commodity price fluctuates, and so you're going to have lumpy free cash flows. Here I've got a base case, a bull case, and a bear case. The base case has been management's fairly conservative guidance this year. Ignore the 2021. It's moving out over a 10-year time horizon. You've got 500 million as management's guidance, and then you've got a bull case, which was their original guidance at 750, which is still fairly conservative, and a bear case would be some unexpected interruption that reduces the expected free cash by roughly 10%. The base, the bull, and the bear case have their given probabilities that you can see in the chart and have a heavy weighting to the bear case. So extremely conservative valuation, whichever way you look at it. The discount rate is their weighted average cost of capital, and the highest multiple I've given them credit for in the bull case is only a 5 multiple. And again, I can hear you screaming at me saying that's way too conservative. Totally fine. You can change all that as you wish. This is just my thought process on paper. Moving down, the expected value of all of those gives us an intrinsic value of $90. And this could easily be double that. Easily. In fact, I more expect it to be somewhere around the 170, 180 mark. When you change some of these assumptions, you'll be able to see that for yourself. If you look at a 2/3 margin of safety, that suggests that $60, let's call it, is a very good margin of safety. So the ability to buy the company at roughly $40 today, for me, I'm very comfortable with that, and I'm happy to give that quite a high weighting in the portfolio. Outside of that, I also purchased and traded some options around the company, and because I just think it's extremely good value. Another way of looking at it, as you know, I like to take things apart and look at it from different angles. Here we've got an assumption of those cash flows from the base case, and said if we bought the company today, I did this on a different day to the first slide, which is why the entry price is different. But essentially here we have to fork out some cash, $41.50, in expectations of getting a stream of cash flows into the future. Are we going to get our money back, and what is going to be the rate of return? That's what this chart essentially calculates. Using the cost of capital as our discount rate, all up, all said and done, we're expecting to get an IRR of 28.5%, which is very, very good and should beat inflation, even in a very high stagflationary environment, which I expect moving forwards. So there we have it. No surprise then, I'm sure, that I'm long the stock inside and outside the eToro portfolio. In the eToro portfolio, you will be able to see that I'm looking to build it to about 5% of assets under management. That would give us a huge amount of torque to the upside in the premier jurisdiction in the world for E&P. We have then, what I'm trying to do is build out a really strong portfolio of companies which have a mixture of fully integrated capacities, so exploration, production, and refining, which you might get with Cenovus, for instance, which is one of our largest positions. Here we're looking almost as a pure play on production in acreage south of the Canadian border, so inside the US. And then obviously we have a more levered company being Callon, Cenovus being less levered. And so you'll have this ability for Cenovus to give a margin of safety. Callon gives a margin of safety when you look at the price versus the potential value, but it has that huge upside, a potential call option on higher oil prices into the future. And then you have Petrobras, which has just a crazily cheap valuation, which has currency headwinds in the sense that currency tailwinds, I really should say, because they're selling oil in US dollars and their input prices are in Brazilian real, which should continue to suffer on the US raising rates, unfortunately, but it's great for their profit margins. You have a different jurisdiction which has less political restrictions on their exploration. And so they can really start to ramp up production, and they're going to give that back as a large amount as a dividend, whereas these guys are going to pay down debt and do a lot more buybacks. So that's what I'm trying to do, is build out a nice portfolio with some geopolitical diversification and currency diversification. So without further ado, long the stock, levered to the oil price. They're rapidly paying down their debt, free cash flow to equity of yielding nearly 40%, and trading at book value. I don't think there's much less to be said for my personal opinion, and so that's why I'm long the stock. Disclaimer, guys, anything that you see on the channel is merely my opinion. It's not advice, and I claim no, I make no guarantees as to the accuracy of the information. It's my collection, and then my opinion. That's all it is. It's what I'm doing with my money and what I manage. Please do not mistake it for advice. You are responsible for your own decisions, and so you need to take that responsibility very, very seriously. I'm not a financial advisor. I have no idea what your circumstances are, so please understand, this may not be right, what I do, and what I do may not be right for you. Okay, they're two very important distinctions that you need to understand. Having said that, I hope that you enjoyed today's video with the new setup. Please leave a comment in the comment section, like and subscribe. And if you are looking for a value-orientated portfolio on eToro to copy, you can click on the link there and you can copy it, or you can simply add us to a watch list and keep an eye on all the updates. Greatly appreciate your input, and I look forward to seeing and hearing from you in the comments section. If you would like to any particular guest, please put their name in the comment section, and I'll do my best to get them on the channel.